Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what we talk about? Well, as you know, I've been talking a lot about Jesse Livermore lately, doing a series on that. But given the market action, I think it's important for us to talk about the market itself, and more specifically, what to do when things get iffy. I'm going to walk you through the open portfolio, what actions we've taken since the top, and what you should continue to do. And that'll make sense in just 1 minute. Housekeeping, I do take requests. It makes my job pretty easy, or a lot easier, I should say, knowing what I'm going to cover ahead of time. You can go to davelandry.com/contact to reach me, let me know. Also, I do a live webinar every Thursday, or usually every Thursday at 6 p.m. Central, 7 Eastern. I'd love to have you there. Bring your questions, bring your favorite stock picks. Twitter, or as they now call it, X, at TFollingMoron, YouTube, at Dave Landry. All right, let's talk about the mystery charts and the methodology in action. Actually, this week there's no mystery charts because there's no new action to be taken. So let's focus on what to do when things get iffy. Now, one thing I'd recommend you do is see each position to its fruition. So just because the market becomes a little choppy or begins to roll over a little bit, that doesn't mean you should pull the plug and just bail out on everything. In fact, quite the contrary. You want to continue to keep your positions open, but let the stops take you out. So let's take a look at LFMD. You can see we had a nice pullback. In fact, that's a Landry Light pullback. Notice below the Landry Light indicator, vis-a-vis the 30 EMA, had a pretty good run. This counts in a number of days, almost 50 days of Landry Light, as you can see, and then it pulls back to the moving average, completing the pattern. So that's a Landry Light pullback. Very simple pattern. In fact, this is probably the pattern you should use if you're just starting to trade. Start with one pattern and build. If you're not successful with one pattern or one setup, you're not going to be successful with 10. Anyway, so there's the parameters, as you can see down below. Entry of 425, stop of $3, IPT of 550. I know it seems a little extreme percent-wise, but that's what it calls for. Also, this is based on a hypothetical 100K, although I do take these trades myself. Entry is there, stop is down here, IPT is here. So let's see what happened. Initially, it did rally a little bit in our favor, which allowed us to bump the stop up a little bit. But so far, it's become dead money. Well, why don't you exit? Well, we don't know. I like to wait and see what happens. If we get stopped out, we get stopped out. We accepted that risk going in to the trade. My point is, if you quit, you're never going to catch any big winners. Now, this might stop out at a loss, so be it. Now, the reason it's important not to exit your positions, I know it's a little counterintuitive. Everybody says cut your losses short, but you have to be willing to make a plan and then live with it. And trading is not a lot like life, but like life, it's making decisions and living with them. And trend following only works with the occasional outliers or home runs. And if you quit early, you're never going to catch a home run. And if you watch these shows and watch my weekend chart shows, you'll see that a lot of times I do those dead money reports just like I just did to show you that sometimes by being patient, you will eventually catch a longer term trend. Now, the bottom line is, because the methodology depends on outliers or occasional home runs, you just don't know when that next home run is going to come along. And if you're constantly quitting, that's a recipe for longer term failure. You must occasionally capture a bigger picture move. So let's see what happened since the top, or possibly a top. We don't know for sure if the market has topped out for good here or not, but for now it looks like we do have a top in place. So you can see we did top out on 727. Again, we don't know if that's going to be the top, but so far it is a top. Now, we take a look at what happened since then. This one stopped out the day before the market topped, so we're not going to worry about that one. But if we take a look at Riot, we had 27.61 in profits, and we ended up stopping out for a gain of 19.72. So that gives us an open profit drawdown of $789. So we take a look at BTBT. We had open profits of $18.84 the day before the market topped, and we closed out that position at $12.63. So that's a difference of $621. VRM, we had open losses of 674, and we ended up stopping out on that one for a $1,976 loss. Now, again, this is on a hypothetical 100K account. I do take these trades, so obviously in these ugly ones, I feel your pain. Anyway, a loss of 1282. LFMD is still open, and based on a mark-to-market on yesterday's price around midday, that was about $80 additional losses on that position. So if we add all this up since the top, it comes to a loss of $2,772 since the market top. And we also had one additional losing trade in there for a loss of $1,636. So if we add all that up, that comes to a loss of $4,408 since the top. Now, some of that is outright losses and some of that is giving up open profits. Now, giving up open profits comes with the territory, and it's something that you just have to live with if you ever are to catch a longer-term trend. Now, we did have one profitable trade so far, and that's K&F. We took partial profits on this one, and there's 676 open profits. So now, since the top, we're down 2,732. Again, some of that open losses and some of that open profit drawdown. Now, if we look at how everything shook out with the mark-to-market on LFMD and K&F, because those are still open, overall, it came to a gain of $646. So that's better than a poke in the eye if you're looking at how everything ultimately turned out from the stocks that we were long at the top. Now, that number is a little bit better when you look at the fact that the market dropped on a closing basis about 4.33%. So at least the portfolio ended up profitable. Yes, you had really big drawdowns from where you were at the top, but overall things turned out okay, and we still have two open positions, so we'll see how that shakes out. Now, when things began to get a little iffy, the first thing you need to remember is no one rings a bell. I remember years ago, before the internet, show you how old I am, in the late 80s and possibly early 90s, there was this software package called Prodigy, and it's kind of like Web 0.1. It did give you a few of the things that you can get today on the web or on your phone, for that matter, such as weather and interconnectivity and sports and news, etc. And what I liked about it was they had a connection to the stock bulletin boards, and I spent hours and hours and hours on those bulletin boards just devouring everything I could. And there was one gentleman that seemed to be fairly knowledgeable about things. At least he posted the most, so I assumed he knew the most, which was a big mistake. Anyway, he was pumping this medical device maker, which actually made medical pumps of all things. And he would pump it and pump it and pump it. And every time something bad would happen or the stock would go down a little bit, he'd pump it some more. And he had these really good explanations for everything. So, like an idiot, I just kept buying this stock, thinking this guy knew more than me. And if I just hung on to it, I would really do well. And me and this gentleman became really friendly. And we'd talk on the phone quite a bit. And one day the stock just absolutely imploded, and I had lost a substantial amount of money, especially since I didn't have a whole lot of money back then to begin with. Anyway, so I called him up with kind of a WTF in mind, and I kind of expected him to say, "Well, Dave, it'll be okay, and stocks go up, stocks go down, and they're gonna be fine. This is a great company," as I've been saying ad nauseum. Maybe give me some comforting words so I could just continue to hang on. He said, "David, no one rings a bell when a stock has topped." And I'll never forget those words. And that was a very, very, very expensive lesson. So just remember, nobody knows when a market has topped, until after the fact, of course. Now, again, you want to see each position to its fruition. One 500% gain makes it all worthwhile. Now, statistically, I realize that's unlikely, but it's 100% unlikely if you quit. Do honor your stops. I'm not saying throw caution to the wind by hanging on to positions. What I'm saying is continue to follow proper money management, let everything play out. But yes, honor your stops, and should you get blessed with a partial profit like we did in the K and F, make sure you take it. Now, here's the secret to trading, if there is a secret, is do become very selective when this happens. You should be selective all the time, but you need to become super selective when the market becomes a little iffy. The good news is the database will produce fewer and fewer setups and fewer meaningful setups when this occurs. I only had 2 or 3 stocks on my watch list coming into today, and none of those stocks am I actually going to buy. Technical analysis gets a bad rap because there's a lot of mumbo jumbo out there. But the way I see it is it's performance-based investing. So you need some sort of performance metric when you are trading stocks. Now, obviously, a stop placed well outside the normal volatility for the position you want to hold, as I've preached before, that's one performance-based metric. Obviously, you want to make sure you're getting into a strong stock to begin with. And we'll take a look at some of those performance-based metrics for the overall market in a few minutes. Now, you're going to have to go through a few cycles, good, bad, and indifferent, or risk being perpetually out of phase. Like I said recently, I think it was on May 3rd, someone emailed me and said, Dave, you haven't recommended anything in a while. Markets are choppy. I don't see any setups for a while. So I'm going to go ahead and quit your trading service. So I said, well, let's just see how things shake out over the next several months. Because the next guy, if he's a trend follower, after going through all that chop and trendless markets, he's going to look like a genius. And I wouldn't say we printed money, but we did exceptionally well over the next several months. So I emailed him to ask him what he thought. Now, at that point, we had began to pull back a little bit. The market had topped out a little bit, and the market started getting a little choppy. And his answer was, well, I don't see anything setting up for a while. Now, the problem here is if you quit once again because it's choppy, you're going to miss the next big move and miss a lot of big winners. So, if the market's choppy and you give up. Now, I'm not saying trade through that chop. You might actually sit on your hands, and sometimes I can go weeks and even months. Now, I remember looking at some old presentations where I went 54 days from setup to setup. Now, there were some setups in between, but they didn't trigger. Just like recently, as I've been showing in the Trading Simplified shows and in the weekly charts, we had quite a few stocks set up, never trigger, and then implode. So no capital was put into harm's way. So by giving up, I'm just saying you go off to chase rainbows or find a new methodology or do something else. But if you give up during those choppy times, you're never going to catch a big trend. You'll never get here. If you give up in the choppy markets, you're never going to catch a big trend. Now, again, if you give up when the market gets iffy once again, which it will, by the way, you're never going to catch that big longer-term trend. By the way, as Greg Morris has pointed out, markets only make new highs about 4% of the time, so you will spend a lot of your time treading water. One thing I've been talking about quite a bit lately is the trader's journey. And we all start sort of from a simple beginning. We're using a blank chart. Then we start thinking if we just find the right indicator, we're going to figure it all out. And before you know it, we study the complex and arcane. And the problem with getting more and more complex with all this and getting out of phase like I just showed is that you can spend 5 to 30 years down in that maze. And I could save you a lot of time just by finding something simple and sticking with it. So let's say you do buy into simplified trend following and you have some success and things are going great. Now, 2 things happen here. One, you think you've got it all figured out and you begin to over leverage and get careless, and that's sort of another conversation altogether. But the other thing that could happen is you will hit the inevitable drawdown. And I see a lot of people, especially those who have initial success, they hit that inevitable drawdown and then they come right back here and they end up on this hamster wheel, sometimes for life. I have people who have emailed me for 20 and in one case nearly 30 years, and they're still on that hamster wheel. I received an email from someone a few weeks back, and he's looking to build some sort of trading system. And it's like, well, what have you done for the past 20 years. Did you not trade anything during that period? So be cognizant of giving up too soon and chasing rainbows. Now, you do have to have a performance-based metric. Like I said, when I get into a position, my stop is outside of the normal volatility. So if I get stopped out, then I know that particular market, stock, or whatever, the trend may have turned. And I might need to get out of the way just in case things worsen. Now, one really simple performance-based metric, and you can get this in ACP, this is the percent of close. And the parameters here are 90 and 50. These are the ones that I use on a weekly chart for the TFM 10% system. So all this is, everything below this area here, means that the market is 10% or more away from its 50-week closing high. Now, Baleo and Gaillard said that bad things tend to happen below the 200-day moving average. Well, you could substitute any performance-based metric for where bad things happen. And I think the TFM 10% system with this percent of close is as good of any performance-based metric. And we'll take a look at a few of them in just one second. Now, as a general statement, when you are within 10% of that closing high, the market is healthy and doing well. When you get further away than 10%, quoting Mr. Baleo and Gaillard again, that's where bad things happen, or bad things tend to happen below that level. So if we take a look at this percent from closing high, that's just simply a measurement to how far away you are from the 50-week closing high. You could see that once you get more than 10% away, the market tends to underperform. And as long as you're within 10% of that closing high, the market tends to do well. So again, it boils down to where bad things happen. Bear markets tend to happen once you're 10% or more away from the 50-week closing high. And you can see, yes, there will be some whipsaws here and there, but as a general statement, once you start getting 10% or more away, you need to really pay attention to what's happening in the overall markets. So you can see the bull markets are mostly above that 10% line. The bear markets are mostly below. Now, not that you want to trade off news, but you can see that bad things such as the pandemic tend to happen when you're below that 10% line. Back here was the financial crisis of 2007. Back here was the end of the greatest bull market in history. So again, when you're above the 10% line, things in general tend to be pretty good. And when you get below it, you need to be concerned. Now, right now, we are back above it, or we have been above it, I should say. And we'll take a look at that in just one second. So again, this is not to say they won't be whipsaw. They will. It's like death and taxes is two things you just can't avoid if you're going to trade. The bottom line is that bad things tend to happen when a market is underperforming. The system was initially designed for the S&P 500, but in more recent times I've discovered it works really well in the Qs. So right here, we had a sell signal, and I'll give you those rules. The rules are, you want to sell when the close is greater than 10% away from the 50-week closing high and the close is below the 50-week simple moving average. I use the moving average as a bit of a whipsaw filter. But you can see right there that sell signal was when we crossed below and closed below the 50-week moving average and also closed below the 10% line. So that's what the sell signal looks like back in early 2022. Now, we got a buy signal here back in April. Now, the buy rules are a little bit more stringent to avoid getting whipsawed. On the sell side, you want to sell first and ask questions later. On the buy side, you don't want to be too early to get into the market. So my whipsaw filter is simply 2 bars of Landry Light and a close within 10% of the 50-week closing high. In other words, above the 10% line. So bar 1, bar 2, Landry Light is simply lows greater than the moving average. So 2 bars of Landry Light you want to buy on that close. This is a weekly chart, by the way. Now, if you take a look at the bow tie moving averages and you look at proper order, meaning the 10 simple is greater than the 20 exponential, and the 20 exponential is greater than 30 exponential. And that is illustrated down here. And this counts the number of bars. You can see it's 21 bars, or 21 weeks in this case, of uptrend proper order. So the market looks pretty healthy on a weekly basis. Now, on a daily basis, not so much. You can see we did have uptrend proper order, obviously coming into that peak. And then since then, just recently, we flipped over to the downside. So we had 2 days of downtrend proper order. Notice that was green, 10 greater than 20, 20 greater than 30. It was yellow, meaning that these moving averages are beginning to cross back and forth. And once they officially cross, then this turns red. Kind of a nice little traffic light type of way to look at markets. So that's a daily. Now, you could drill down with this and look at the hourly chart. I have a client that does a lot of work with market timing. He's been trading since the 70s. And he likes to take a look at the hourly charts. And he's got a lot of investments, but he'll actually bail out when the hourly chart starts to look questionable as far as his longer term market timing. So I think that's kind of a neat thing. The danger with that is you could end up with a little whipsaw when it's not a top. But you can see here that coming into the slide, obviously we were in uptrend proper order in an hourly chart. But then in early August, the moving averages flipped back over to the downside. So again, this is on a 60-minute chart. And you can see that we've been in downtrend proper order for a long, long time. Little yellow here when the 10 crossed just briefly above the 20 EMA. But as you can see, for the most part, it was red and we've been in a downtrend. And now the moving averages are crossing back over to the upside. We don't know if this is just going to be a retrace or the bottom, but for now, things are improving once again. So if we take a look at the Landry light with the 30 EMA, you can see so far, at least for the last 21 weeks, this just counts the number of bars, we have been above that 30 EMA. So that's something that you should pay attention to on a weekly basis. Now on a daily chart, we do have downside Landry light for the last 4 or 5 days, as you can see below that 30 EMA. Now an hourly chart, once again, it's looking better. You can see we've got 3 hours so far at least above that 30 EMA. So you probably want to take a look at different time frames to see where we are. And remember, the hourly is going to turn before the daily is going to turn before the weekly. Don't get too caught up in the weekly because you're going to have a lot of lag. Don't get too caught up in the hourly because you're going to have a lot of whipsaw. But it pays to kind of look at all these things so you can see the forest for the trees. So in summary, when things get a little iffy, you want to stay the course, okay? Don't throw caution to the wind, but don't bail out on everything every time the market becomes questionable, because it'll become questionable quite a bit, believe me. You have to go through all the cycles, good, bad, and indifferent, or risk being perpetually out of phase. This gentleman earlier, he quit when things got choppy, and then he watched the market take off, and now he's going to continue to quit because things are choppy again. One has to wonder if he'll ever catch a trend. Do let your stops take you out. Again, we're not throwing caution to the wind. If we get stopped out, so be it. Do be super selective, even more selective than you normally are. Make sure you're really excited when you see a setup. Make sure it's a mother of all setups, especially if the overall market is questionable and the sector itself is somewhat questionable. And again, make sure you have some sort of performance-based metric. That's going to be stops on your individual positions, and then something like the TFM 10% system with the 10% line, and bow tie proper order along with Landry light. Those things can let you know where you are in the cycle. And if the cycle isn't good, then again, be super selective before you start putting on new positions. By the way, real quick, if you want to look at the archives to all these stocks that I talk about, or nearly all these stocks I talk about in these presentations, you can go to davelerner.com/archives and check them out. Well, that's my time for this week. I want to thank everybody for watching. Again, if you need follow-up information, the slides from this presentation, and a bunch of more stuff, you can go to davelerner.com/stockcharts. So again, thanks for watching, and may the trend be with you.